Previously, we have covered all these topics. Today, following the same roadmap, we will understand the Dragonfly Doji, Gravestone Doji, Hanging Man, and Long Wick Candlestick patterns in detail under basic price action. Let's first learn about the Dragonfly Doji. The Dragonfly Doji is a single candlestick pattern consisting of just one candle. This candle forms when sellers push the price down after the candle opens, but buyers enter the market at lower levels and push the price up, closing the candle near its opening. This means sellers have failed to keep the price down and buyers are overpowering sellers, forming a Dragonfly Doji candle with a long lower wick on the chart. This candle has almost no body and the lower wick is much longer than the candle body. The Dragonfly Doji candle indicates rejection from lower levels in the market. The color of this candle does not matter, it can be either red or green. Sometimes it may also have a small upper wick. Now let's look at an example. This is a 5-minute time frame chart. As soon as the market opens, the price faces rejection from lower levels, forming a long wick candle on the chart, which we call a Dragonfly Doji candle. This signals a bullish reversal, indicating that the market is trying to form support at this level. Therefore, buyers repeatedly try to push the price up, causing the price to trade within a range for some time. As sellers fail, buying pressure increases in the market, and the price breaks out of this range with a strong green candle. If a green bullish candle forms after the Dragonfly Doji candle, you can enter a long trade by placing your stop loss below the support area. The chances of a market reversal increase if the Dragonfly Doji candle forms near a strong support area. Now let's understand the Gravestone Doji. The Gravestone Doji is also a single candlestick pattern. Buyers with strong bullish sentiment push the price up, forming a strong green bullish candle on the chart. But at higher levels, sellers enter the market and push the price down, closing the candle near its opening. This forms a small-bodied candle with a long upper wick on the chart, known as a Gravestone Doji candle. In this candle, the body is much smaller compared to the wick. Here, the buyer's strength is weak, and the sellers overpower them, bringing the price down from above. The Gravestone Doji candle acts as a bearish reversal signal. Now let's look at some examples. This is a 5-minute time frame chart. After the market opens, it tries to break out to the upside but fails. Buyers enter the market from the lower level and gradually try to push the price up again, but fail to break the day's high. This forms a trend line at the lower levels on the chart, indicating that whenever the price touches this trend line, buyers start buying and push the price up. This trend line acts as the last support for buyers, and if it breaks, buyers may panic about their positions. Here, buyers try to lift the price from the lower level but fail to break their day high due to low buying pressure. This means that the day high level is acting as a strong rejection level in the market. After a while, the price breaks the day swing low with a strong bearish candle and moves down rapidly. Now let's learn about the Hanging Man candle. The Hanging Man is a single candlestick pattern. When the market is in a short-term uptrend and the price reaches its nearest resistance area, as soon as the candle opens near this resistance level, sellers enter the market and push the price down. However, the price then moves up again, closing near its opening level. Here, buyers are strong from the lower level and move the price upwards, but as soon as the price reaches the resistance area, sellers start entering the market, seeing the resistance at higher levels, causing the candle to try to go down for a while. This forms a Hanging Man candle with a long lower wick on the chart. Here, the market fails to continue its previous bullish momentum, resulting in no breakout of the resistance level, and sellers gradually start selling. This causes the next candle to close at lower levels, scaring the buyers who start booking their profits. This increases the selling pressure at higher levels, and as soon as the price breaks the low of the Hanging Man candle, it moves down rapidly. Here, you can place a stop loss above the high of the Hanging Man candle or slightly above the resistance level and enter a short trade. Now let's understand how to trade multiple long wick candles. Whenever the market is in a downtrend and the price forms such multiple long wick candles on the chart near its nearest support level, it means that the previous trend of the market is gradually weakening. Here, sellers actively sell from higher levels, bringing the price down with big bearish candles. But as soon as the price reaches the support area, it faces rejection from the lower area, forming long wicks downwards in the candles. Sellers repeatedly fail to close the candles lower. This means that the selling pressure near the support area is gradually decreasing, causing the price to trade in a range within the support area. Seeing the sellers weakening, buyers start entering the market, and the price breaks out of this range and moves upwards. For example, if we look at the 5-minute time frame chart, the price moves down initially, forming big bearish red candles. But afterwards, the size of the candle starts to decrease, and long wicks begin to form at the bottom of the candles. This indicates that the seller's strength in the market is diminishing, causing the price to trade within a range and form a support area on the chart. The initial momentum in the market has now decreased. Additionally, on this day, the weekly options expiry also takes place, causing the premiums of the put options held by sellers at higher levels to increase rapidly due to this momentum. However, as the market speed slows down near the support area, the premiums of their put options start to decrease rapidly due to theta decay, reducing their profits. The longer the market trades sideways within a range, the more anxious the sellers become as they see their premiums decreasing. After a while, the market breaks out of this range and moves upwards, prompting buyers to start buying. Due to the market trading within this range for a long time, the sellers' profits decrease further, causing them to exit their positions. This increases the buying pressure, and the price rapidly moves up, hitting all the sellers' stop losses. This way, without looking at a single candle, you can identify a good trading opportunity in the market by observing the behavior of multiple candles. I request all traders to practice the concepts discussed in this video as much as possible to understand them better. If you like this video, please like it and subscribe to our channel. Thank you.